It is kind of funny. If you take a stroll through almost any suburban neighborhood on a Saturday afternoon, you are practically guaranteed to hear a very specific soundtrack.
Oh, yeah. I know exactly what you mean.
Right. You hear that sharp, just inescapable thwack of a pickleball hitting a paddle.
Yeah. Or the rhythmic thumping of a basketball on asphalt.
Exactly.
Yeah.
Followed by the heavy clanging of the rim. And we experience these things purely as leisure. It is just a weekend hobby.
Right. It's how we blow off steam.
Yeah. Or get a little cardiovascular exercise, maybe get, way too competitive with the neighbors over a backyard game.
Definitely.
But if you actually pull back the curtain on that idyllic Saturday afternoon, if you really look at the engineering, the supply chain logistics, and the sheer capital deployed to put that specific paddle in your hand.
It is staggering.
It really is.
Yeah.
You realize you are not just playing a game. You are participating in a massive, fiercely competitive corporate battlefield.
And the margins for error on that battlefield are incredibly thin, especially in the macroeconomic climate we're navigating right now.
Right.
These companies aren't just thinking about how to make a bouncy ball, They are actively navigating volatile global supply chains, fluctuating commodity prices, and intense freight costs.
Not to mention sudden drastic shifts in consumer confidence.
Exactly. Which can happen literally overnight.
So today on Talk Tickers, we are pointing our microscope directly at a company that is right in the thick of this recreational arms race. We are diving into the Q2 2026 earnings call of Escalade.
Ticker symbol ESCA.
Yep, ESCA. They are a major player in the sporting and recreational equipment market. And chances are incredibly high that you or someone you know currently owns something they make.
Oh, absolutely. Whether it's an ONIX pickleball paddle, a heavy-duty Goalrilla basketball hoop, or some specialized bear archery gear.
Right. We have the full transcript from their latest earnings call, featuring CEO Patrick Griffin and CFO Stephen Warren. And our mission for this deep dive is to translate these Wall Street data points into a masterclass on corporate survival and strategy.
Because, we're looking well beyond the headline numbers today. The goal is to understand the actual mechanics of their operations.
Exactly.
Like, how does a company position itself to aggressively capture market share when the average consumer is feeling, the heavy pinch of inflation?
Yeah, it's tough out there.
Yeah.
So we're going to extract vital lessons on pricing power, inventory management, and the specific financial strategies behind corporate acquisitions.
Which is super actionable for our listeners. These are lessons that apply whether you are an active retail investor analyzing a stock, an entrepreneur, or just a curious consumer.
Right, who just wants to understand why that new pool hoop costs what it does.
But before we get into the tactile, cool stuff, the aerospace-grade carbon fiber tech and all that we have to set the financial stage.
We got to look at the raw numbers. Yeah, the Q2 numbers that had management taking a bit of a victory lap, because the headlines they look utterly fantastic on paper.
But the devil is always in the details.
Always. So let's strip down that financial snapshot. Top line revenue, their net sales, hit $57.7 million.
Which, in a retail environment where we know discretionary consumer spending is highly stressed, a 6% year-over-year increase is a formidable achievement.
It really is. Moving down the income statement, net income sat at $9.4 million. That translates to 68 cents per diluted share.
Pretty solid.
But the metric that fundamentally shifts the narrative, the one that makes financial analysts sit up in their chairs, is the gross margin. It expanded by 146 basis points, bringing their total gross margin to 26.2%.
And finally, we have EBITDA, earnings before interest, taxes, depreciation, and amortization. It came in at a staggering $13.2 million.
Wow.
Yeah, that is a massive leap from just $3.9 million in the exact same quarter last year.
I want to freeze on that gross margin number for a second, though, because, a 146 basis point expansion sounds like the kind of microscopic corporate jargon that makes people's eyes glaze over.
Right. Sounds tiny.
But in the reality of physical retail and manufacturing, that is a seismic shift. For anyone who doesn't spend their days staring at spreadsheets, a basis point is just 1/100th of a percentage point.
So 146 basis points is almost a 1.5% increase.
Exactly. It means for every $100 of revenue they bring in, they are keeping an extra $1.50 in gross profit before they even start paying for operating expenses.
Like marketing or corporate salaries. And the CFO, Stephen Warren, was very deliberate in explaining how they achieved that margin expansion.
Right. He had two main reasons.
Yep. He attributed it directly to higher fixed cost absorption driven by increased volumes, alongside what he called a favorable sales mix.
Okay, hold on. I need to stop you there. Because higher fixed cost absorption, that is exactly the kind of financial terminology that obscures what is actually happening on the ground.
It is a bit dense, yeah.
Like, what does that actually mean for the workers on the factory floor or the accountants managing the warehouse leases?
So, to understand fixed cost absorption, you have to separate a company's expenses into two buckets. You've got variable costs and fixed costs.
Okay.
Variable costs change depending on how many items you make. If Escalade makes one extra archery bow, they have to buy the specific fiberglass and string for that one bow. That cost varies.
Makes sense.
But fixed costs are the heavy burdens that do not change, regardless of whether you manufacture 10 bows or 10,000 bows.
So we're talking about the monthly rent on the massive manufacturing facility?
Exactly. The rent, the base utility bills to keep the industrial lights on, the depreciation of the multi-million-dollar machinery sitting on the factory floor.
And the baseline salaries of the plant managers, right?
Right. It's essentially a massive overhead burden.
Okay, I am tracking with you. So the factory costs a small fortune just to exist, even if it's completely empty. Let me try an analogy here to see if I have the mechanics of this right.
Go for it.
Think of fixed cost absorption like renting a massive luxury party bus for a night out.
Okay, I like where this is going. Let's see how the math plays out on this bus.
Right, so let's say renting this party bus costs you a flat $1,000 for the night. That is your fixed cost.
Yep.
The driver doesn't care if you put 5 people on the bus or 50 people on the bus. The invoice is $1,000. Now, if you only convince 10 friends to buy a ticket, you have to charge them $100 a head just to break even.
Which means your margin is terrible, your friends are mad about the price, and you aren't making any money.
Exactly. But if you manage to hustle and sell 50 tickets, your fixed cost per passenger drops all the way down to $20.
The bus itself didn't get any cheaper to rent.
Nope. The driver didn't offer a discount. But because your volume of passengers went up, you absorbed that $1,000 fixed cost much more efficiently across a wider base.
Right.
So every ticket you sell past that break-even point is suddenly pure, unadulterated profit.
That is a perfect analogy. Take that party bus logic and apply it directly to Escalade's physical infrastructure.
Okay.
They have sprawling facilities, heavy machinery, baseline operational costs, and because their top-line sales volume increased by 6%, they were able to run significantly more physical product through that pre-existing infrastructure.
Right. So the cost of running the actual factory didn't go up proportionally with the spike in sales.
Exactly. Therefore, the unit cost to manufacture each individual pickleball paddle or basketball hoop dropped.
The profit margin on those extra items expands significantly because the fixed costs have already been paid for by the initial baseline volume.
That is the magic of operating leverage.
So the factory is absolutely humming, the party bus is fully packed, and they are printing money on every extra unit they sell.
Yep.
Plus, you mentioned they had a favorable sales mix, which I assume just means they managed to sell a higher proportion of their really expensive high-margin gear.
Rather than their cheap, low-margin stuff.
I see.
Exactly.
You combine more volume over fixed assets with selling pricier gear, and boom, you get that 146 basis point jump in margin.
That is the operational success story of the quarter. But the financial narrative takes a very sharp turn when we look closely at the bottom line.
And this is where I really have to push back on the victory lap management was taking on this call.
Yeah, I know exactly what you're going to say.
Because if you look at that EBITDA number again, it is frankly unbelievable. It jumped from 3.9 million last year to 13.2 million this quarter. They more than tripled their earnings.
Right, on paper.
But if you read the actual transcript of the call, CEO Patrick Griffin drops a massive, unavoidable caveat.
Yeah.
Of that 13.2 million in EBITDA, 9.9 million of it is what they categorize as a non-recurring tariff recovery.
The phantom windfall. It dramatically skews the entire perception of the quarter.
It is a complete phantom windfall. It's a refund from tariff costs they paid to the government in prior quarters. It makes this current quarter look like an absolute goldmine, but it's essentially a one-time check in the mail.
A very large check.
Yeah. So let's just do some quick mental math here. If your total reported EBITDA is 13.2 million, and 9.9 million of that is a magical one-time government refund,
then your actual regular operational EBITDA for the quarter, the money you made from actually running your business, was only 3.3 million.
which paints a completely different picture. An operational EBITDA of 3.3 million is actually lower than the $3.9 million they posted in the exact same quarter last year.
Yeah, it shrunk.
So my question to you from an actual talk ticker's perspective, are these massive headline numbers actively hiding an operational squeeze?
It's a fair question.
Right. The gross margin went up, the sales volume went up, they absorbed their fixed costs beautifully. But when we strip out the lucky tariff refund, the actual operating profit from selling sporting goods seems to have shrunk.
Right.
If the factories are more efficient and they're selling more stuff, what exactly is eating all that extra money before it reaches the bottom line?
So the discrepancy comes from a specific line item on the income statement, SG&A.
Selling, general, and administrative expenses.
Exactly. It's the corporate overhead. If you dig into the management commentary, they note that their SG&A expenses increased by $2.2 million year over year.
Wow.
Yeah, landing at a hefty $12.5 million for the quarter.
Where is that extra $2.2 million going? Because, I mean, that is a massive chunk of change to just evaporate into administrative costs in a single quarter.
Well, the management team pointed to two primary culprits. First, they experienced higher variable compensation.
Okay.
This is the double-edged sword of top-line growth. Variable compensation usually refers to performance bonuses, sales commissions, and management incentives that are directly tied to hitting revenue targets.
Oh, I see.
Yeah. If your sales force successfully pushes that top line up 6% in a tough economy, the compensation structures dictate that you have to pay them for it.
Right. I guess you can't be mad at that.
Yeah.
If the people selling the party bus tickets fill the bus, you have to pay them their commission.
Wall Street generally accepts this kind of expense because it means the company is successfully growing revenue. But the second factor is much more complex and speaks to their broader corporate strategy.
What's the second factor?
A significant portion of that SG&A spike comes from the lingering costs associated with recent acquisitions. Late in 2025, Escalade went out and bought two businesses, Gold Tip Archery and All Cornhole.
And buying a business isn't just a matter of changing the name on the door and collecting their profits.
Far from it. The reality of corporate mergers is incredibly messy.
Yeah.
When you acquire a company, you aren't just acquiring their revenue stream or their cool brand name, you are acquiring their entire operational mess.
Right, you inherit their payroll obligation.
Exactly. Their middle management salaries, their redundant software subscriptions, and their administrative overhead.
Wow.
Integrating those entirely new business systems into Escalade's pre-existing corporate structure adds a massive temporary layer of SG&A cost. You have to pay severance for redundant roles, hire consultants to merge the IT networks, all of it.
Untangling overlapping logistics.
Right.
So if we synthesize this entire financial picture for the investor listening, the gross profit, the actual money they make on the factory floor from manufacturing and selling the physical product, is getting significantly better because they are running more volume through the machines.
They're getting that fixed cost absorption.
Right. But the administrative bloat, the friction and cost of running the expanded corporate machine and swallowing two new companies has temporarily eaten into their operating profit.
Yes. And this $9.9 million tariff refund perfectly masks this temporary squeeze on the balance sheet.
Perfect timing for them.
It really is. It allows them to report an absolute blowout quarter to the public markets, keeping the stock price happy while they quietly do the very messy, expensive work of absorbing those new companies behind the scenes.
It provides them with incredible financial air cover during a vulnerable integration period. I mean, that's a bullish signal for management competence, even if the operating numbers are a bit noisy.
Absolutely.
All right, so we have the financial mechanics completely mapped out. We understand the phantom windfall, the margin expansion, and the SG&A growing pains. But none of this financial engineering matters unless real people are actually walking into stores or going online and buying this stuff.
Right, the actual products.
Yeah. So what exactly is flying off the shelves to drive a 6% sales increase in this economy?
The product portfolio reveals a very deliberate, highly calculated pivot. Escalade is actively moving away from the casual, entry-level sporting goods market and shifting aggressively toward high-end, technologically advanced gear designed for the enthusiast.
The premium tier. Let's break this down category by category based on exactly what they highlighted in the earnings call.
Okay.
First up on their list was Archery. They noted strong, sustained growth driven primarily by their Bear Archery brand, but they didn't highlight entry-level youth bows.
No, they didn't.
They highlighted a slew of new product launches in their Trophy Ridge accessory line. They debuted these at the ATA show, which is the Archery Trade Association's massive annual industry event.
Right. We're talking about highly specialized, newly engineered sights, mechanical releases, and advanced stabilizers.
Plus, they got an incremental revenue boost from fully integrating that gold tip acquisition we just talked about.
Exactly. And the key takeaway from their archery segment is that the growth is entirely accessory and upgrade driven. They are targeting a consumer who already owns a bow and is heavily invested in the sport.
Right, a beginner might buy a cheap all-in-one starter kit, but a new high-tech stabilizer or a micro-adjustable sight is a purchase made by a dedicated enthusiast.
Someone who is actively looking for incremental performance gains. They are selling precision, not just participation.
Which brings us perfectly to pickleball, the absolute cultural and recreational phenomenon of the current decade.
Oh yeah, it's everywhere.
Their ONIX brand launched 2 specific new paddles this quarter, the Hype Light and the Adaptamax. Now, I want you to listen to the specific marketing jargon and engineering terminology used to describe this AdaptX paddle.
It's intense.
It really is.
Yeah.
The transcript highlights that it features MaxRev technology, a raw carbon fiber surface, and a patented carbon fiber power frame. We aren't talking about the wooden paddles you used in middle school gym class anymore.
No, the evolution of pickleball equipment mirrors the evolution of golf clubs or tennis rackets.
Right.
It moves from basic wood to lightweight composites and eventually to aerospace-grade materials.
Yeah.
That raw carbon fiber surface they are touting is designed to provide maximum grit and friction, allowing the player to impart massive spin on the ball.
And the patented carbon frame.
That's about maximizing the sweet spot while reducing the physical weight to prevent elbow strain.
It's incredible.
Yeah.
But the escalation of materials doesn't stop at pickleball. Don't forget the billiards category. They highlighted the launch of the Lucasi Halo carbon fiber shaft for pool cues.
Right.
The transcript specifically points out, with obvious pride, that this shaft is engineered with T700 carbon fiber to deliver, quote, low deflection performance and a smooth, consistent stroke.
Now, that is a very specific flex.
It is. I actually had to pause and look this up in our engineering glossary because I wanted to know what T700 actually is. T700 is a specific high tensile strength industrial grade carbon fiber manufactured by Toray.
It's serious stuff.
It's the exact kind of high modulus material you expect to find woven into the pressure vessels of a spacecraft or in the chassis of a Formula One racing car.
Natural.
And Escalade is deploying it so someone can hit a cue ball with slightly less deflection at their local pub on a Friday night.
It sounds absurd, but the physics behind why they use T700 is actually quite fascinating, and it explains their entire business model.
How so?
Well, when you strike a cue ball off-center to apply spin, what pool players call English,
Right.
a standard wooden cue shaft flexes upon impact. That microscopic flex pushes the cue ball slightly off the intended line of aim. In billiards, this is known as deflection or squirt.
Okay.
The player has to subconsciously calculate and compensate for that error on every single shot. But by utilizing incredibly stiff T700 carbon fiber, the shaft barely flexes at all.
Yep.
The deflection is drastically reduced. The ball goes exactly where you aim, even with massive amounts of spin.
So you are essentially buying a cheat code. You are buying a material that artificially covers up the flaws in your own physical stroke.
Exactly. And you see that dynamic play out in almost every enthusiast sport. The equipment is engineered to lower the barrier to high performance.
Right.
Escalade's overarching product strategy is becoming crystal clear through these examples. They have zero interest in winning a race to the bottom on price at big box discount retailers.
They are not trying to manufacture the absolute cheapest paddle or the most affordable pool cue just to move volume.
No, instead, they are aggressively engineering high-performance upgrades to capture the serious player.
The person who doesn't just want to casually knock a ball around, but the person who wants to completely dominate their friends and feels that technology is the way to do it.
The enthusiast who truly believes that a T700 carbon fiber shaft or a MaxRev raw carbon surface will give them a definitive competitive edge. And when you successfully target and sell to that specific psychological profile, you unlock immense pricing power.
Which is what we care about here at Talk Tickers.
Right. A casual weekend player might balk at spending an extra $50 on a paddle, but an enthusiast, someone whose identity is tied to the sport, will gladly spend hundreds, sometimes thousands of dollars for a perceived boost in precision, power, or durability.
That makes total sense. This strategic focus effectively elevates their entire brand portfolio out of the generic toy aisle and positions it squarely in the professional equipment category, where the profit margins are exponentially higher.
It's a very smart defensive move.
Now, I completely understand the psychology of the carbon fiber pool cue, but the product that absolutely fascinated me the most in this entire earnings transcript, the one that really shows off their strategic thinking, wasn't the aerospace billiard shaft or the raw carbon pickleball paddle.
What was it?
It was tucked away in the basketball category. They introduced a new product called the Goalrilla Hydro Dunk.
Ah, the heavy-duty pool hoop.
Yes. But I need to be clear here for the listener. This is not just a flimsy PVC plastic toy hoop that you toss in the shallow end of the pool for the kids to play with.
Not at all.
Escalade took their flagship, Pro Game Engineering, the exact same heavy-duty tempered glass backboards, the massive steel poles, and the regulation breakaway rims that they use for their multi-$1,000 luxury driveway systems. And they completely rebuilt it from the molecular level up.
Yeah, they re-engineered the entire system.
Using highly specialized, corrosion-resistant, salt and chlorine-safe materials. They built a professional-grade, indestructible basketball system designed to be permanently anchored into the concrete decking right next to a swimming pool.
This specific product launch is an absolute masterclass in market expansion and lateral innovation.
Walk us through the strategic brilliance of this, because on the surface, to a casual observer, it just sounds like a very niche, incredibly expensive product designed for affluent people with nice backyard pools.
Well, while it certainly targets an affluent demographic, the brilliance lies in the product development life cycle. If a company wants to grow, inventing an entirely new sport from scratch or trying to capture a consumer demographic they have absolutely zero history with is incredibly expensive.
And time-consuming.
And fraught with risk. You have to educate the market, build brand awareness, hope the trend catches on. What Escalade has done with the Hydro Dunk is look at their most successful, proven flagship product, the heavy-duty Goalrilla driveway hoop, and simply asked a fundamental question.
Which is,
where else can we physically put this?
they didn't try to reinvent the wheel. They just figured out how to make their best-selling wheel completely waterproof.
Exactly. That lateral thinking changes the entire trajectory of the product line. Standard powder-coated steel, no matter how tough it is in a driveway, gets eaten alive by the highly corrosive environment of a saltwater or chlorine swimming pool.
It rusts, it weakens, and it fails.
Right. So by investing the R&D to source and engineer materials that can withstand that specific harsh chemical environment, they took a product that had largely saturated the high-end driveway market, and they instantly opened up an entirely new, massive, untapped physical environment.
A backyard pool market.
Yep.
And it changes who sells it too. Now it's an incredibly high-margin upsell for professional pool contractors building custom backyards.
Exactly.
It's a premium architectural addition for homeowners looking to upgrade their outdoor living space. And most importantly, Escalade utilizes their existing manufacturing expertise, their existing supply chains, and their existing brand equity.
They essentially created a brand new, high-margin revenue stream without having to take the risk of inventing a new category. It is highly efficient innovation.
Okay, so this all paints a picture of a company focused on the very top of the market. But with all this high-end tech, the aerospace T700 carbon fiber, the advanced chlorine-safe engineering, the raw carbon pickleball friction surfaces, I have to ask a broader question about their long-term viability. Are they intentionally leaving the casual weekend warrior completely behind? Like, is there a systemic risk here? If you price out the average middle-class family who just wants a cheap, durable paddle for a Sunday afternoon at the local park, are you dangerously shrinking your total addressable customer base?
It's a great point.
Or has consumer behavior fundamentally shifted and people are simply demanding professional-grade gear for their casual backyard hobbies?
That exact tension is the million-dollar question facing the entire retail sector right now. But looking at the data, I would argue that the casual, price-sensitive consumer isn't being abandoned or ignored by Escalade. No, they're simply being outsourced. Escalade is intentionally letting their competitors or the flood of cheaper, unbranded overseas imports fight over those low-margin, entry-level customers.
I see.
Escalade's management seems to have made a highly calculated, data-driven decision that the real sustainable profit margin is located exclusively in the premium tier.
Because the consumer they are aggressively targeting is the one who watches professional pickleball tournaments on television and demands to use the exact same paddle the pros are using.
Regardless of the cost. The psychological element of aspirational spending cannot be overstated here.
Right.
Purchasing the high-end, heavily marketed gear makes the consumer feel more invested, more legitimate, and more serious about their chosen hobby. It validates their participation.
It's the exact same reason amateur cyclists buy $10,000 carbon fiber bikes just to ride on a paved bike path on Sundays.
Exactly.
You buy the T700 carbon fiber pool cue because the physical weight and the branding make you feel like a professional shark in the pub, even if you still miss the crucial 8-ball shot.
And from a pure business logistics perspective, selling one single high-margin premium item is almost always more profitable and requires significantly less logistical headache, warehousing space, and customer service bandwidth than trying to manufacture, ship, and sell 10 low-margin entry-level items.
All right, so the strategic shift to premiumization is clearly working for their top-tier products. It's great that high-end, raw carbon pickleball paddles and indestructible chlorine-proof pool hoops are flying off the shelves.
Good.
But we need to look at the entire picture because not every single product category was a winner in this quarter. In fact, if you read closely, the transcript highlights a specific glaring weakness in one particular area.
Yes, it does.
And this weakness points to a much, much larger economic storm brewing on the macroeconomic horizon.
As much as any management team tries to control their own destiny with brilliant product engineering and clever marketing, the company still has to operate within the undeniable gravity of the broader U.S. economy.
Right. Let's pivot to the macro reality check. Patrick Griffin, the CEO, contrasted the amazing double-digit growth in their archery and basketball segments with what he very cautiously termed softer consumer demand in their outdoor games category.
Now, to be clear, when we talk about outdoor games, we are talking about the basics. We are talking about simple cornhole sets, bocce ball, croquet.
The standard, affordable lawn games you buy at a big box store.
Right.
And Griffin didn't just mention this softening in passing. He used it to offer a pretty stark, sobering warning to investors about the second half of 2026.
He was remarkably transparent, explicitly warning the market about looming macroeconomic headwinds that could derail consumer spending.
He listed the threats out bullet point by bullet point. He cited sustained inflationary pressures, significantly higher energy costs, and elevated prices across the broader economy.
It's a tough environment.
He flat out told the analysts on the call that these factors could heavily weigh on consumer discretionary spending and simultaneously create incremental pressure on Escalade's own cost structure.
It is a very sober, realistic assessment of the economic fragility right now.
Yeah.
And the dichotomy within their own earnings report is fascinating because it perfectly illustrates the current economic divide. The high-end, expensive enthusiast gear is selling incredibly well, but the basic, accessible, casual outdoor games are softening rapidly.
Which aligns perfectly with historical data on how different demographics behave in sustained inflationary environments, doesn't it?
Absolutely. The affluent consumer, or the deeply dedicated hobbyist who prioritizes their sport above all else, continues to spend freely on their passions. Their wealth insulates them from the immediate shock of inflation.
But the average middle-class or lower-income consumer, the person who might have previously bought a basic $50 lawn game on a whim for a neighborhood barbecue, is feeling the severe compounding pinch of inflation.
At the grocery store checkout and at the gas pump.
Right. When the price of eggs and fuel spikes, they immediately cut back on discretionary, casual impulse purchases like a new Boss set.
Because selling a $300 architectural tool hoop requires a consumer who actually has $300 in disposable income to spare.
Yeah.
When we look at the other side of Escalade's product catalog, the reality of the broader economy starts to crack the facade of the retail boom.
So this brings us to a critical operational question for any retail investor looking at this stock. How is Escalade actually dealing with this inflation internally?
That's the real test.
Because it's not just the consumer who is hurting. Escalade's own operational costs, the global ocean freight to ship the products, the raw materials like steel and carbon fiber, the energy required to run the massive manufacturing plants, those costs are all skyrocketing too.
They absolutely are.
And in standard corporate logic, the playbook for inflation is incredibly simple. When your costs go up, you immediately raise prices on the consumer to protect your profit margins.
But aggressively raising prices in the current environment is incredibly dangerous.
Why is that?
Because if consumer demand is already demonstrably softening for basic items, raising the price tag on those items might completely kill that demand. You run the very real risk of pricing your products right out of the market and destroying your sales volume entirely.
And this dilemma is where that phantom windfall we spent so much time on in the first segment, that magical $9.9 million tariff refund, completely transforms.
It really does. It goes from being just a nice one-time accounting bonus on a spreadsheet into a weaponized strategic asset.
How they are deploying this tariff money is arguably the most crucial, aggressive, strategic maneuver revealed in the entire earnings call.
Oh, without a doubt.
So walk us through this specific pricing playbook. How exactly are they deploying this $9.9 million pile of cash to fight inflation?
CEO Patrick Griffin stated very clearly on the call that they plan to use the $9.9 million tariff refund to, quote, absorb some of the additional freight expenses, and furthermore, to actively support incremental promotions in the third and fourth quarters.
Let me frame this for you, the listener, because when you truly internalize what they're doing, it's a wild, highly aggressive strategy.
It is.
Think about it this way. This is the equivalent of finding $10,000 buried in a coffee can in your backyard. Most rational people would take that sudden found money and put it into a high-yield savings account, or maybe use it to responsibly pay down the principal on their mortgage.
Right.
But what Escalade is doing is taking that found money and using it to subsidize their daily inflating grocery bills, specifically so they don't have to change their lifestyle or tighten their belt, even though the actual cost of groceries has gotten way more expensive.
It is a deliberate, highly calculated choice to financially shield the end consumer from the reality of inflation.
Wow.
Instead of passing their higher freight, energy, and commodity costs onto the buyer through price hikes, which would preserve their margins but likely crush their sales volume, Escalade is choosing to eat those increased costs internally.
And they are paying for that hit using the $9.9 million tariff refund money.
Exactly.
Yeah.
Furthermore, they aren't just holding the line on prices. They are taking a portion of that found money and actually lowering prices temporarily through targeted promotions and discounts.
So picture the retail landscape. While all of Escalade's competitors are being brutally forced to raise their retail prices just to survive the inflationary pressure and keep their lights on, Escalade is sitting there holding the line on pricing or even offering discounts.
From a purely competitive standpoint, it is a brilliant, aggressive move. It allows them to ruthlessly capture market share from weakened competitors.
If you are a consumer standing in a sporting goods store comparing two pickleball paddles, and you see that competitor A's paddle has gone up in price by 15% due to inflation, while the Escalade paddle right next to it has stayed exactly the same price or is incredibly on sale, you're going to buy the Escalade product.
They are literally buying long-term customer loyalty and stealing market share by subsidizing the price with this government refund check.
It sounds incredibly brilliant in the short term, yes, but it also sounds like a remarkably dangerous high-wire act.
It has its risks.
Going back to my backyard coffee can analogy, it feels fantastic to use that buried money to buy expensive groceries right now. You feel rich, your lifestyle is great, and you aren't feeling the pain of inflation. But what happens when you dig up the coffee can in 2027 and it's completely empty? That tariff refund is strictly non-recurring. It is a one-time historical event. What happens next year when global ocean freight costs are still sky high, raw materials are still expensive, but the government isn't sending any more $9 million refund checks in the mail to subsidize the margins?
That is the massive structural risk management is taking. And it is exactly why analysts scrutinize these calls. If macroeconomic conditions do not fundamentally improve, if global freight rates do not normalize, or energy costs remain structurally high, Escalade will eventually face... Yes. And at that critical juncture, they will be forced into a terrible choice. Either accept severely degraded profit margins that will tank the stock price, or institute massive delayed price hikes on the consumer all at once, which could result in a sudden, catastrophic shock to consumer demand.
It's a massive, high-stakes gamble on the exact timing of the global economic recovery.
It is.
Griffin even admitted as much during the Q&A section of the call. He literally said, "We're hoping that the freight will be transitory, that geopolitical situations wind down, hopefully." I have to say, the word hopefully is doing an incredible amount of heavy lifting in that sentence for a publicly traded company.
It absolutely is. But if we connect this dangerous pricing gamble back to their product engineering strategy, the logic becomes a bit more apparent.
Okay, how so?
By pushing so heavily and aggressively into the premium enthusiast categories, the T700 carbon fiber shafts, the high-end raw carbon pickleball paddles, the architectural pool hoops, They are actively building a product portfolio that naturally possesses much higher baseline margins and significant pricing power.
Right.
They are using the temporary tariff money to buy themselves the time necessary to transition the bulk of their business away from low-margin long games and into these highly profitable enthusiast items.
Ah, I see.
If they can execute that product transition fast enough, they might not actually need the tariff subsidy next year because the products themselves will be inherently profitable enough to absorb the inflation organically.
All right, so to survive a high-stakes, clock-ticking gamble like that, to ensure you can weather the economic storm when that one-time cash finally runs dry, a company has to have an absolutely bulletproof financial foundation.
They certainly do.
Which brings us to what might be the most impressive, yet honestly the most unglamorous and misunderstood part of this entire earnings call. How Escalade fundamentally manages its physical closets and its corporate bank accounts.
We are diving into the mechanics of balance sheet mastery.
Yes, let's talk about the balance sheet. Now, I know that talking about physical inventory levels and corporate debt structures isn't nearly as sexy or futuristic as talking about aerospace carbon fiber, but I promise you, this is where the real enduring business is actually done.
It's the lifeblood of the company.
Let's look at the hard metrics from the quarter. Total physical inventory dropped by $1.5 million year over year, landing at $73.6 million.
That specific reduction is a staggering operational achievement when you understand the broader context of what the company was doing during that same period.
Right, because normally dropping your inventory by $1.5 million just means you successfully sold some stuff out of the warehouse. But the transcript explicitly points out, and management took great pride in noting, that they achieved this $1.5 million reduction despite simultaneously adding massive amounts of new inventory from the two late 2025 acquisitions, Gold Tip Archery and All Cornhole.
When Escalade bought those two companies, they didn't just buy the intellectual property and the brand names. They physically bought warehouses packed to the rafters with thousands of archery arrows, bows, and literal pallets of cornhole bags.
And all of that physical mass, that new inventory, was instantly dumped onto Escalade's consolidated balance sheet.
Exactly. So for their overall combined inventory number to actually go down year over year, it means the warehouse operations team had to aggressively, ruthlessly flesh out not only their own legacy stock of Escalade products, but they also had to rapidly churn through the massive, newly acquired pile of stuff they just bought.
This physical reality brings us to a critical financial metric that Escalade's management is clearly obsessed with. And frankly, a metric that any business owner, from a local hardware store to a global manufacturer, must intimately understand. Inventory turns.
Inventory turns, yes.
Okay, let's unpack this for the listener.
What exactly is an inventory turn in practice? And why did management specifically state that their long-term structural target is a 3x turn?
An inventory turn is a financial and operational ratio that shows exactly how many times a company has completely sold through and subsequently replaced its entire physical stock of inventory during a specific period, which is usually measured over a year.
So just to keep the math simple, a 1x turn means it takes you a full 12 months to sell every single item sitting in your warehouse. Exactly. And a 3x turn, which is the holy grail they're aiming for, means they want the velocity of their sales to be so high that they completely cycle through their entire warehouse inventory every 4 months. 3 full cycles per year.
Why is a higher number always better? Why is 3x the magic target?
Because you have to understand what inventory actually is. Inventory is not just boxes on a shelf. Inventory is literally your company's cash, trapped in physical, illiquid form.
Trapped cash.
Yeah. When you have millions of dollars tied up in a warehouse full of heavy basketball hoops or thousands of pickleball paddles, you cannot use that trapped money to pay your employees' salaries. You cannot use it to acquire a new, exciting company, and you certainly cannot earn yield on it in a bank account.
Furthermore, physical inventory actively bleeds money. It costs exorbitant amounts in commercial real estate leases to store it. It requires climate control. It could be physically damaged by forklifts or floods. And in the sporting goods world, it can quickly become technologically obsolete.
That's absolutely right. Achieving a 3x turn means you are a highly liquid, incredibly efficient operation. You are taking raw materials, converting them into finished goods, and then converting those goods into cold, hard cash at a blistering pace.
Decreasing their total inventory by $1.5 million while simultaneously absorbing the inventory of 2 entirely new companies proves that Escalade is becoming radically more efficient at this exact conversion process.
They are operating as a highly tuned cash-generating machine.
And what exactly are they doing with all that newly generated cash? This is the second half of the balance sheet mastery that jumped out at me. The transcript proudly announces that the company has officially reached a net cash position.
That's a huge milestone.
They currently have $16.4 million in pure cash sitting around, which, by the way, is a massive increase of $3.3 million just from the first quarter alone versus only $14.9 million in total current debt. And they actually paid down $1.8 million of that debt in this quarter.
Achieving a net cash position is the absolute defensive holy grail for any physical retail manufacturer operating in a turbulent, unpredictable economy.
Why is it the holy grail?
It fundamentally means that if the economy collapsed tomorrow and every single creditor and bank knocked on Escalade's corporate doors demanding immediate repayment in full, Escalade could write a single check, clear all of their debt entirely, and still have over $1 million left over in the bank to keep the lights on.
It is the ultimate defensive sleep well at night posture.
Yeah.
You literally cannot go bankrupt if you hold more cash than debt.
Exactly.
But here is the specific part of the transcript that I want to challenge you on because it initially confused me. The CEO mentioned that the company is currently benefiting from a, quote, favorable cash arbitrage in the current interest rate environment.
Ah, yes. The treasury strategy.
What does favorable cash arbitrage actually mean in plain English? And honestly, if a company has $16.4 million in cash sitting in the bank and they only owe $14.9 million in debt, why not just pull the trigger? Why not write the massive check, wipe the corporate debt out completely to absolute zero, and operate as a totally debt-free entity?
It's a common question.
Is there some sort of psychological benefit they get from Wall Street by holding on to the debt? Or is this just a complex math equation they are playing with the banks?
It is entirely a math equation, and it is a brilliant exploitation of the current macroeconomic environment. To understand it, we have to look at the history of interest rates over the last few years.
Okay.
The term arbitrage simply means taking advantage of a price difference between two different markets to make a risk-free profit. Let's break down the specific math of Escalade's balance sheet. Escalade holds what they describe as low-cost, fixed-rate bank debt.
Meaning they locked in the interest rate a while ago, and it can't change.
Precisely. Let's look at the historical context. Let's hypothesize they secured this term loan or revolving credit facility back in 2020 or 2021 during the era of zero interest rate policy, or ZRRP.
Right, when money was free.
The Federal Reserve had slashed rates to zero to stimulate the economy. During that time, corporations could borrow money for practically nothing. So Escalade locked in a fixed rate of, let's say, 3 or 4% on that $14.9 million of debt.
Okay, so they have incredibly cheap legacy money.
Very cheap money. But now, flash forward to 2026, the macroeconomic environment has completely flipped. The Federal Reserve rapidly hiked interest rates to fight the very inflation we've been discussing.
Right.
Because the baseline rates are so high now, a corporate treasury department can take millions of dollars in cash, park it in a highly liquid money market account, or buy short-term U.S. Treasury bills, and earn a 5 or maybe even 6% yield, completely risk-free, backed by the government.
Ah. I see exactly where this math is going.
The corporate treasury department becomes a profit center. They are paying the bank their legacy rate of, say, 3% on the money they owe, but they are earning 5% from the government on the $16.4 million in cash they hold.
The macroeconomic environment is essentially paying Escalade a 2% spread simply to maintain their debt.
Exactly. If they took their massive cash pile and paid off the $14.9 million debt tomorrow, yes, they would save the 3% interest expense, but they would instantly lose the 5% interest income they are generating on that cash. It would actually cost them hundreds of thousands of dollars in lost yield to become debt-free.
That is wild. It's a complete financial masterstroke born out of the weirdness of the current economy. They're literally getting paid by the spread to hold on to their debt. But surely corporate strategy isn't just about earning a few percentage points of interest in a money market account.
No.
That $16.4 million in cash is highly strategic, right? They aren't just hoarding it to earn yield.
Earning the arbitrage yield is just a nice temporary bonus provided by the Fed. The real fundamental reason you hoard that much cash, while carefully maintaining a perfectly manageable low-interest debt load, is optionality.
Optionality.
Financial optionality is the most valuable asset a company can have in a volatile market. Management has explicitly stated in the call that this liquidity is the primary fuel for their next major phase of corporate growth. They aren't holding the cash just to look at the bank statements. They are keeping their powder dry for targeted acquisitions.
Which perfectly sets up the final piece of the strategic puzzle revealed in this transcript, the M&A playbook, mergers and acquisitions. Because if you have built a hyper-efficient 3x turning machine that rapidly converts inventory into cash, and you've successfully amassed a massive war chest of liquidity, the fastest way to achieve explosive growth isn't necessarily to spend years inventing new products in a lab.
It takes too long.
The fastest way to grow is to go out and buy other companies that have already done the hard work.
And management was incredibly clear on this point during the call. They actively indicated a, quote, growing pipeline of strategic accretive acquisitions, specifically designed to enhance their existing platforms and cement their competitive positioning.
I want to focus on that specific word. Accretive. It's a classic Wall Street buzzword. They used it heavily to describe the September 2025 acquisition of Gold Tip Archery.
They did.
The CFO stated directly that Gold Tip provided immediate incremental sales and was, quote, accretive to second quarter results. What exactly makes an acquisition truly accretive in this operational context?
An accretive acquisition is the gold standard of M&A. It means that the company you just bought adds more value to your bottom line specifically. It increases your overall earnings per share than it actually cost you to acquire and integrate them.
Okay, so it's not just about buying top-line revenue.
Exactly. Any foolish company can buy revenue if they are willing to overspend and take on massive debt. The strategic goal is to buy highly profitable revenue that immediately makes the parent company more valuable.
So how exactly did the Gold Tip acquisition do that so quickly? They only bought the archery company late last year. They had to deal with all the messy SG&A integration costs we discussed earlier, and yet Gold Tip is already boosting Escalade's Q2 bottom line results. How did they turn it profitable so fast?
It all comes back to that relentless 3x inventory turn machine we just discussed in the balance sheet section.
Oh, I see.
When a massive conglomerate like Escalade buys a smaller niche company like Gold Tip, they are primarily buying the respect of the consumer. They are buying a beloved brand with a deeply loyal, enthusiast customer base.
Right.
But typically, these smaller, founder-led or niche companies do not have world-class global supply chains. They don't have massive optimized distribution networks, and they certainly don't have the back-office efficiency or purchasing power that a giant like Escalade commands.
Right. They are incredibly good at engineering and making arrows, but they are probably not world-class experts at negotiating ocean freight rates or managing global warehouse logistics.
And that is exactly where the value is unlocked. Escalade buys them, strips out all the redundant administrative overhead, which causes that temporary spike in SG&A we saw, and then completely unplugs Gold Tip's inefficient legacy supply chain.
So they swap it out.
They plug the Gold Tip brand directly into Escalade's hyper-efficient, massive corporate machine. Suddenly, without changing the product itself, the profit margins on every single Gold Tip arrow sold expand dramatically.
Wow.
Escalade can source the raw materials cheaper due to volume purchasing, they can manufacture it more efficiently, they can ship it faster, and they can absorb the fixed costs much better than the smaller company ever could on its own.
It's a classic textbook roll-up strategy. You completely dominate niche sporting categories, not by trying to build a new brand from scratch, which takes decades of time and millions of dollars in risky marketing, but by acquiring the already beloved, established brands and ruthlessly supercharging their back-end operations.
And the cash hoard is the key to this entire strategy. When the macroeconomic environment gets rough, as CEO Patrick Griffin specifically warned it might, smaller, independent competitors get incredibly stressed.
Yeah, they feel it first.
Their borrowing costs go up because they don't have fixed-rate legacy debt, their profit margins compress due to inflation, and they eventually become desperate for a buyout.
And Escalade's just sitting there.
Sitting patiently on a mountain of $16.4 million in cash and a bulletproof balance sheet. They can swoop in and acquire these struggling but deeply valuable brands at a massive discount to their true value.
So for the listener who is trying to synthesize all this and apply it to their own business decisions, or maybe trying to refine their own stock investing framework here at Talk Tickers, what is the ultimate operational lesson here?
It's a great question.
Because we've seen Escalade successfully execute both strategies in this single quarter. They innovated incredibly well in-house with the Goalrilla Hydro Dunk, creating an entirely new chlorine-safe product category from scratch. But they also went out and bought the winner by acquiring Gold Tip Archery. Is it ultimately better for a company to innovate organically or simply acquire?
The fundamental lesson of this earnings call is that the most resilient, dominant companies do not choose between the two. They do both, but they apply them to completely different strategic problems.
Elaborate on that.
You choose to innovate in-house when you want to expand the utility of an existing proven asset. Think of the Hydro Dunk. Escalade already owned the engineering expertise for heavy-duty hoops, they already owned the manufacturing molds, and they owned the intellectual property. They simply needed to adapt the material science to make it safe for the pool environment.
It's a low-risk, incredibly high-reward maneuver because you are building on a foundation you already control.
However, you choose to acquire when you want to enter a highly specialized niche or capture a completely new demographic where your current brand has absolutely zero credibility.
Like high-end archery.
Right. Escalade could have spent millions trying to build a high-end archery brand completely from scratch to compete with Gold Tip, but they would have spent years fighting an uphill battle trying to convince serious, skeptical archers to trust a new brand.
It's just not worth it.
It is infinitely more efficient and often cheaper in the long run to simply buy the hard-earned trust that Gold Tip has already built over decades and then apply your superior operational efficiency to scale it.
It's the stark difference between trying to learn a complex new language fluently from scratch versus simply using your massive cash pile to hire the absolute best translator in the world on day one.
That's a great way to put it. And doing both simultaneously driving organic lateral innovation alongside strategic accretive acquisitions is exactly what creates that unstoppable flywheel effect of compounding corporate growth, even in a terrible economy.
Let's step back and synthesize everything we've unpacked today, because we have covered a massive amount of ground, from macroeconomics to material science. We started by looking at the raw anatomy of Escalade's Q2 2026 quarter. It's a fascinating story of a company that is executing relentlessly on multiple complex fronts.
It serves as a true masterclass in defensive, calculated growth.
On one hand, you have this relentless, almost clinical operational efficiency. They are successfully absorbing their fixed costs across their factories. They are aggressively driving down physical inventory despite buying new companies. They're pushing toward that 3x inventory turn target, and they're flushing massive amounts of cash onto a bulletproof balance sheet to exploit interest rate arbitrage.
They're operating the back-end machine better than they ever have.
And they are parlaying that back-end operational efficiency into high-end, consumer-facing product innovation. They have recognized that the bottom of the market is toxic, so they aren't fighting in the mud for the cheapest dollar.
Right. They are utilizing aerospace-grade T700 carbon fiber and raw MaxRev technology to capture the premium enthusiast consumer, the exact demographic that is statistically less sensitive to the economic turbulence crushing the middle class.
And then, of course, you have the wild card, the lucky break, the $9.9 million non-recurring phantom windfall from the tariff refund.
Which is huge.
But as we discussed at length, the brilliance isn't just that they got lucky with a government check. It's how strategically they're deploying that luck. They're weaponizing that phantom windfall to absorb the pain of inflation internally, shield their consumers from necessary price hikes, and aggressively steal market share from weaker competitors who don't have a giant government check to fall back on.
It's a formidable, aggressive strategy. For an investor, it's a very bullish signal of competent management. They're pulling every single lever at their disposal, factory operations, product mix, and savvy capital allocation to navigate what is undeniably a very tricky, dangerous macroeconomic environment.
But as we wrap up this analysis, I want to leave you, the listener, with a final, lingering question to ponder on your own. It circles all the way back to where we started this conversation, looking at the folks playing pickleball in the suburbs or shooting hoops in the driveway.
The reality on the ground.
Exactly. We saw a very clear, undeniable divergence in the data of this earnings call. The ultra-premium gear, the $300 carbon paddles, the architectural chlorine-proof pool hoops, the aerospace-grade billiards shafts, those items are driving massive, highly profitable growth.
But the basic accessible outdoor games, the simple stuff the average middle-class family might buy for a picnic, that demand is softening rapidly as the economy relentlessly pressures their wallets.
The economic divide is widening, and it is showing up in the sales of lawn games.
It really is.
So as this economic pressure continues to squeeze the middle class, is this corporate pivot toward ultra-premium, high-tech sporting goods going to be the ultimate sustainable savior for the retail industry? Will it successfully sustain these companies through the coming turbulence? Or, by pricing out the casual weekend warrior and focusing solely on high-margin carbon fiber tech, are companies like Escalade just building better, more expensive toys for a continually shrinking pool of affluent buyers?
That is the fundamental structural tension of the current U.S. economy. And it is perfectly encapsulated in the material science of a pickleball paddle.
Next time you hear that distinctive thwack of the ball on a Saturday afternoon, or the splash of a hydro dunk in a backyard pool, you'll know exactly the financial and strategic states behind the game. Thanks for joining us on this deep dive. We'll see you next time.